Hi, I'm Howard Lothrop, host of Echo Partners TV. I've developed this series of videos to help answer some of those questions that I frequently get from clients. I'm going to start with what is the most commonly asked question that I get. It might be a little hard to believe, but that question simply is, what is interest rate risk? Interest rate risk is the risk that a bank's earnings or capital may suffer due solely to changes in the movements of interest rates. So the question then becomes, how does this happen? Well, it's a simple enough process. Let's just assume that we have a short-term deposit that funds a longer-term fixed-rate loan. If interest rates rise, the income from the loan doesn't change, but the cost of the deposit will increase, thereby compressing the margin on this transaction and the bank's overall net interest margin. Interest rate risk is one of those concepts that seems very straightforward when you discuss it, but it wasn't always the case. Going into the 1980s, which became a time of high and volatile interest rates, savings and loans typically funded long-term 30-year mortgages with short-term deposits. As rates rose precipitously during the 1980s, they became upside down, many of them did, and that's when we had the S&L crisis. It also led to the beginning of modern-day asset liability management. And if there's one concept you should take away from this, it's simply that you should match the repricing frequency of your assets and your liabilities. That way, they will react similarly to changes in the movement of interest rates. In our next episode, we'll talk about how exactly we might want to measure interest rate risk. Thanks very much.